It's time for Yahoo Finance's Market Minute. Stocks climbing as investors digest rebounding consumer confidence, as well as an agreement between U.S. and the EU to accelerate trade talks. Nvidia shares rising as investors look ahead to Wednesday's earnings report, hoping to get updates on AI chip demand. Nvidia shares are flat year to date after whipsawing amid growing fears of AI competition and tariff concerns. And President Trump is looking to cancel all federal funds directed to Harvard University. The U.S. General Services Administration sending letters to federal agencies telling them to end contracts totaling about $100 million. This was first reported by the New York Times. And it comes after the administration froze about $3.2 billion in grants and contracts with the Ivy League University and tried to halt its ability to enroll international students. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In, we're going to talk to one portfolio manager about 3 stocks to play right now, spanning 3 different sectors. And AI darling Nvidia reports earnings this week. Stocks and Translation host Jared Blickery going to take us through the company's journey to its $3 trillion market cap. Plus, all week long, in honor of National 529 Day, we'll be discussing the 529 College Savings Plan and how it could fit into your personal finances. We got a packed show. Let's get right into it. First, taking a look at some of the market action 90 minutes into the trading day. Major averages higher across the board. Stocks rising after President Trump delays tariffs on the EU. My next guest is watching 3 standout stocks amid continued volatility. Joining me now, we've got Michael Sansatera, who is the Sylvant Capital Management CIO, Managing Director, and Senior Portfolio Manager. Good to have you here with us. So let's start with Netflix. Walk us through what you like about NFLX shares right now.
Sure. Thanks, Brad. Netflix continues to be the #1 streaming content provider globally. They've held their position despite, aggressive competition from the Disneys, HBO Maxes, Paramounts, Apples of the world for the last few years. We saw a little bit of lull in their growth a few years back as that competition increased, but now they're really back on top. Still spending the most money on content, a very large slate of good content coming at the second half of the year, stuff that's well proven and has generated subscriber growth. And I think we're actually at the point finally with Netflix where we've stopped worrying about subscriber growth specifically. That's a data set they're not giving us any longer, and we can really drill into the financials. The stock's expensive, but you're going to see, I think, better and better operating margins, better contribution from their ad tier revenue, and increased price increases. So it's a stock that we think can continue to exceed investors' expectations, is not bothered by tariffs, and is doing a pretty good job of bucking the trend of even in a concerning economic environment and sort of volatile market conditions.
Yeah, indeed. We've seen NFLX shares up by about 35% over the course of 2025 here, continuing to track that move. Also watching one of the other names that's on your list, and this is Mercado Libre. This is not a company that might kind of fall into the regular conversations, but why is this one at the top of your watch list?
Yeah, we like Mercado Libre. We have for some time now. It's the Amazon of South America, simply put. And what we've seen there is really their ability to hold Amazon at bay with a lot of these burgeoning countries, particularly in Brazil. So you've got a company where you're growing revenue, gross margin volume. So basically the merchandise they sell, gross merchandise volume, north of 40% globally, 30% in Brazil this most recent quarter, which I think was greater than investors expected. And at the same time, taking some plays from the Amazon Web and Amazon Playbook, you've seen Mercado Libre increase their fulfillment. So a larger portion of their business is now being fulfilled by themselves, which means their cost per fulfillment is lower. And that's allowed them to continue to monetize the sales that they generate on the platform. Additionally, and maybe even more so than even an Amazon, is their credit business. A large portion of South America is still unbanked. And when you need to borrow money to buy stuff online, Mercado Libre is right there to lend you the money. So you've seen a company that it's been very challenging to catch all the moves with with foreign exchange, it's been very challenging to really gauge any one particular country's movement. But when you back up as a whole and you look at where they sit in that industry and where they sit geographically, it's a company whose expectations continue to rise. Very hard to model, which stocks we typically like. And what you see is a good outperforming stock that's continuing to take market share.
It seems like this would be part of that kind of international diversification play that we're increasingly hearing, especially coming off of the early innings of the year where all of the talk was about U.S. exceptionalism, and that is the portfolio strategy. But now we've seen investors and some of the strategists that we speak with here on Yahoo Finance talk more about where you need to have some emerging market exposure, and specifically outside of the U.S. Is Mercado Libre not just that play, but how do you kind of build a basket that includes Mercado Libre and some of the other analogous type of companies?
Sure. At the Virtus Sylvan Focused Growth Mutual Fund and Strategy, we're really focused on U.S. companies by and large, but we allow ourselves a small percentage of the fund, never more than 10%, in these very specific cases. So what we don't want to do is make a call on the U.S. economy versus South American economy versus Asia. Our goal is just to pick the best stocks. So when we can find a company like Mercado Libre that we can get good research on, we can understand, we can track its key metrics, we can add that to our portfolio, not only to help total return, but to your point, have a little bit less U.S. economic exposure in the fund itself. Again, not an international fund. It's something we typically own very small positions in relative to the rest of the strategy, but it is important to consider how can they exceed investors' expectations? How can their key metrics, the way they've managed their business, beat what's already priced in? And Melly has done a very good job of doing that for the last several years.
Let's talk about one more that you're tracking here, GE Aerospace. What's appealing there?
Sure. We've liked GE once they spun out the pieces of the company, particularly the aerospace division was something we were interested in. Historically, at Sylvant, we weren't particularly interested beyond much more than that. So we were excited to see that spin out, purchase the shares a few years back. And we've been tracking really the expectations around engine deliveries. You've seen GE really dominate the narrow body engine business. You've seen clients, customers, both business and retail travel increase over the last few years, which means more demand for planes, more demand for these more highly efficient engines. And despite the fact that the supply chain has been a little bit challenged, GE has exceeded expectations. Despite the fact that some of the OEM production, particularly from Boeing, has been capped, they've managed to beat expectations. And part of that's been on their services business and their spare parts business, which are growing mid-teens to 20% respectively. And that's the kind of business we really like because it's long tail. We think that the travel plans of most people are still largely intact globally. These engines are really dominant in their space. And GE is really capitalizing on the pure thing that they used to do before they became an unwieldy conglomerate. They're really capitalizing on the GE Aerospace portion of the business, and we think that continues for multiple years.
Michael, good to see you. Thanks so much for taking the time.
Thanks, Brad.
Now time for some of today's trending tickers. We are watching Southwest Airlines, LifeStance Health Group, and AutoZone. First up, Southwest Airlines announcing new pricing for checked bags. Starting May 28th, your first checked bag will cost $35 and your second will cost $45, according to the Wall Street Journal. There will be some exceptions to this rule. Meanwhile, the airline is getting an upgrade at Jefferies to hold from underperform. The analyst notes more confidence that the airline's efforts will pay off, citing things like price adjustments and flight availability, and new distribution channels, cutting flights to cities that aren't doing well, and creating new intentional connections here. And the firm's new price target, $33. That's up around 6.5% upside from the stock's last close. There you're taking a look at shares here today, moving higher by about nearly 5%. Next up, we've got LifeStance Health Group. They're getting an upgrade to buy from neutral at UBS, and the firm says the health stock is undervalued and has more than 50% upside from its last close. The analyst says that the stock may be overlooked due to conservative current quarter and full year guidance and a change from a stock to cash incentive program. The firm sees the pullback in shares so far this year as a buying opportunity. And AutoZone is falling after a mixed third quarter report. The comparable sales, they came in better than expected. Earnings per share and gross margin for the quarter, though, they missed estimates. William Blair says despite some of the choppiness around earnings, they remain buyers of the stock. JP Morgan says the strength of the sales beat and commentary around momentum should keep investors engaged, noting any dip in the stock is likely to be short-lived. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, coming up, ahead of Nvidia earnings, we're going to discuss the AI giant's path to $3 trillion. And we'll talk about whether a sales slowdown could be a broader warning to the AI trade. Stay tuned for that. You don't want to miss it.
Nvidia's sales growth, it is cooling fast, down to 80% from over 250% just a year ago. Now, Nvidia is a poster child for the AI-fueled bull market, so ahead of Wednesday's big earnings announcement, investors are asking, is this slowdown? Is it a warning sign for the entire AI trade? Let's take a look now at how Nvidia got to this point. I'm Jared Blickery, host of Stocks in Translation. So in green bars behind me, you're going to see Nvidia's quarterly revenue in billions of dollars scaled on the right axis. The white line is year-over-year sales growth as a percentage scaled on the left. And this chart goes all the way back to 1999. That's when they IPO'd. Now, early on, Nvidia benefited from the first ever graphics chips, but growth cratered during the dot-com bust, going negative by 2002. In 2006, Nvidia found new life with its parallel computing platform, CUDA, boosting sales growth back into positive territory until the global financial crisis hit, dragging sales deeply negative again by 2009. But another growth spike came in 2016 to 18 with the Pascal chip launch and crypto mining boom. This pushed growth over 50%, but by early 2019, the crypto hangover hit hard, with sales falling by as much as 31% year over year. Then came the pandemic, boosting sales growth back into double-digit territory once again by 2020 as gaming and data centers surge. But nothing compares to Nvidia's AI supercycle. In 23 and 24, early growth or yearly growth spiked to record levels, peaking at an incredible 265% in April of last year. And this is as quarterly revenue hit $26 billion. So now the question is whether the recent drop to only 80% growth, does that signal the beginning of the end for this AI-fueled run, or does it accelerate once again? So let's take a different look now at how Nvidia's market cap has grown since the end of the last century. Now, market cap is simply the current stock price multiplied by all the shares outstanding. And another note, the chart is in log scale, meaning that the numbers increase quickly as you go up. Each identified level to the left is 10 times more than the prior number. So from 1 billion to 10 billion to 100 billion, then finally $1 trillion on the left. Now, starting after an initial surge during the dot-com boom, Nvidia hit $10 billion in market cap in December of 2001. And this is a level that acted like a magnet, kind of holding the stock roughly in place for over a decade. But it wasn't until 2016, the launch of Pascal and that first big AI bet, that the stock finally broke out, becoming a 10-bagger, multiplying in value 10 times in less than 3 years. But big drops hit again, getting cut in half in the 2018 crypto crash and 65% from 2022 from AI export controls and slowing demand. Then finally in May 23, one massive AI-driven earnings beat added nearly $250 billion in a single day, making Nvidia the first chip maker to join the $1 trillion club. By early 24, the company had hit $2 trillion, again on another blowout earnings report. And in June 24, it peaked at $3 trillion, finally topping King Apple as the most valuable company in the world. And currently, that title is held by Microsoft. So with Nvidia earnings right on investors' doorstep, Wall Street will see if the chipmaker's growth is simply cooling and set to accelerate again, or if the AI boom is beginning to fade. Either way, it's not just Nvidia on the line, it might be the entire AI trade. Tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you. Consumer confidence rebounded in May after 5 consecutive months of declines, jumping to 98 from a reading of 86 in April. with expectations for the future surging over 17 points to 72.8, still below the 80 level, which typically signals a recession ahead. Joining me now on this is Yelena Shaletyeva, who is the Conference Board Senior U.S. Economist. Yelena, always a pleasure to grab some time with you here. Just take us into what we're ultimately seeing in terms of the consumers and what's driving the most recent readings as of right now.
Well, we saw a significant rebound from the depths that we observed over the last several months. Nonetheless, despite this rebound, which basically bet all the expectations in the consensus of economists, we are only back to the low levels that we observed back in 2024. So it's, in a sense, it's only a partial rebound. So the cutoff date for this particular survey for the preliminary May reading was May 19th. So that means it doesn't include the period during which we heard that tariffs may go up on European goods, and what's probably more important, that tariffs may go up on components for Apple products. So 25% tariff on Apple products could be, could make consumers feel a little bit less optimistic, but we'll see. So also what's interesting is that tariffs obviously was the driver behind a significant rebound. We split the sample on May 12th, and what we saw is that we saw some improvement before that date, but there was a lot of improvement following the US-China trade deal.
And so with that in mind, I was taking a look at the expectations index, which is essentially the outlook, the short-term outlook for income, business, labor market conditions, and that is at 72.8, remaining below this threshold of 80, which we know typically signals a recession ahead. Is that something that you're placing a high probability of, and how that is actually factoring as well through to the consumer mindset as they're assessing their own opportunities both in employment and how that trickles through to their spending?
Sure. The recession probability, we also ask consumers about that. We saw a decline in consumers' assessment of a recession. Here at the Conference Board, we have not expected a recession either before the US-China trade deal was announced or obviously after that. We see a significant slowdown in economic growth towards the end of the year, but by no means a recession. I think what consumers are telling us is that they are concerned about tariffs, so there's no doubt about that. We see it in their write-ins, for example, but I think what they're telling us, they are not so much concerned about the state of the labor market as much. So they still have jobs, and as long as they have jobs, they will continue to spend. We asked consumers some special questions in the survey this time, and 1/3 of them are telling us that they are putting aside some money, so for a rainy day, so to say, if they can. So we could see a slowdown in consumer spending just because of that. Not because their finances are bad or because they're losing job, but just because they are more concerned about the future. So another thing is that half of consumers are concerned about not being able to afford the goods that they would like to purchase.
And just lastly, while we have you here, does it seem like a lot of those purchases are being dramatically shifted, whether that is the decision to go out and eat during a week, or even the decision to go on vacation or buy a larger purchase, a good, like a car?
So we saw declines in those things, but in the May survey, we saw a significant rebound in all across different goods and services. Consumers entering the summer period with some optimism here. So let's hope that will last.
Yelena, good to see you. Thanks so much for taking the time. Coming up, what the latest housing data tells us about the spring selling season. That is next on Well. get a check up in the markets right now as we are just about 2 hours into the trading session, just shy of it right now. But the Dow Jones Industrial Average, you're seeing that higher on today's activity by about 1.25%. This is the 5 trailing sessions here. Let's put this on an intraday chart just so you can see what we've been watching closely here. And we're hovering around some of the intraday session highs there for the Dow, the NASDAQ composite, just about the same case where actually it looks like we're at that session high, up by about 2% right now. And the S&P 500, you're seeing that up by about 1.6% as well, also in the ballpark of its session highs here on the day. This is after, of course, we've seen that rebound start to take place and emerge off of, another tariff announcement that took place right before the extended weekend here. And as we're taking a look at the S&P 500 and the major averages with the pause and some of the positive talk, we could say, we'll potentially see negotiations move forward with cooler heads, and that is why you're seeing all of the major averages move higher. And so that in mind, let's take a look at some of the sector activity. And ultimately here intraday, not a spot of red on the board. Right now, we're being led by consumer discretionary and technology. Both of those higher by about 2%. Since we've got technology as one of our leaders, let's take a look at the NASDAQ 100 here. Just a few spots of red peppered in. PDD is earnings related here, as that's down by about 15% on the day. The margin's disappointing there in that most recent report. However, you got a lot of the mega cap tech stocks, those Mag 7s. They are strongly in positive territory here on the day. As right now, taking a look at Meta, Apple, Nvidia, all of those up roughly about 2% or more right now. So we'll continue to track that as we move forward with the rest of today's trading session. Home prices are at historic highs, and the latest read from the S&P Case-Shiller National Home Price Index shows that potential buyers have had a tough road ahead here. Here to break down the report, we've got Yahoo Finance senior housing reporter Claire Boston. Claire, what is the latest movement on home prices right now?
Hi, Brad. So in March, we saw a 3.4% annual gain nationally compared to a year earlier. And that is actually down a little bit from a 4% gain in February. So we're still seeing that home prices are still rising, but that rate of growth is slowing a little bit. And this 3.4% number was a little bit of a bigger deceleration than economists were expecting. One other thing I'm looking at right now is that month over month, prices actually fell a little bit, just 0.3% down nationally. But that's another sign here that the market is slowing a bit, even though things are still very, very expensive.
Do you think this is going to impact the spring and summer home buying season, which I guess we're kind of in the unofficial start of summer as of right now?
Yeah, so this data is from March. And so if you remember back in March, we had not yet had that tariff surprise. And we do have a little bit more data about what spring home buying is looking like. And a lot of signs point to a pretty slowing market. So potentially in the months ahead, we may continue to see that deceleration, maybe a little bit even of a price move down month over month.
Some more data here. Zillow and Redfin, they both expect home values to decline by about 1% this year. Are buyers better off waiting?
It is really hard to tell. Something I talk about all the time is how regional the housing market is. And when you're looking at this Case-Shiller data, places like New York, home prices are up 8%. Chicago is up close to 6%. But then you look at a place like Tampa and prices are down. So it really depends on where you are and what your market is doing. And, it's hard to tell right now. It's a weird market.
Claire, thanks so much. Appreciate it.
Thank you.
Straight ahead, we've got all your markets action. Stay tuned. You're watching Yahoo Finance. This week on Wealth, we're breaking down one of the most useful savings accounts around, a 529 plan. 529 plans are a type of investment account that can be used for higher education savings, and they're usually sponsored by states. And they are so powerful because of the tax savings. Your earnings grow federally, tax-deferred, and qualified withdrawals are tax-free, among other benefits. Here to help us review some of the basics, we've got Jennifer Hollers, LPL Financial Senior Vice President and Head of High Net Worth Planning Services. Jennifer, good to have you here with us. So how do you go about choosing a 529 plan?
Well, first of all, 529 plans can be chosen by state, but you're not restricted to your state. So it's really more about the 529 plan that works for you and your family.
Okay, and so how do you figure out how much to save?
Strategies in regard to saving. I think the first and best strategy is saving early and saving often. So an individual can actually contribute $19,000 a year for tax purposes to a 529 plan. Married couples can save up to $38,000 a year in a 529 plan. And so those are some amounts you want to consider potentially putting into the plan. But depending on where your child goes to school, whether it's private or public, you want to think about the amount you want to save in those plans.
And so as you're managing the account throughout your child's life, what is that process like? How do you plan effectively for managing the account?
Sure. Well, I think an interesting component to 529 plans is that recently there's been an expansion in what you can save for. So historically, 529 plans have been for college expenses, but now in recent years, legislation has opened it up to K through 12, actually funding school loans or paying back school loans up to $10,000, and then also converting to a Roth if you have leftover funds up to $35,000 a year. So that's pretty compelling in regard to what 529 plans can be used for beyond college expenses.
So what about when it's time to withdraw from this account? How do you go about that?
So qualified withdrawals are best used for school tuition, books, supplies, and room and board. And an interesting piece about room and board is that can actually pay for off-campus and or living with family with certain restrictions around it and calculations. But typically you want to look at the cost of education to the school that your kiddo is going to, and you could potentially even withdraw as a qualified for the living with family.
Now, I know that you focus on high net worth planning as well. So how are higher net worth folks thinking about funding a 529?
Sure. So there's something called super funding that we have found high net worth families tend to be very interested in. And so back to that $19,000 per individual contribution a year for tax gift or gift tax exclusion. If you want to continually super fund, then you could actually give $38,000 per married couple into the 529 plan and 5x that. So that's $190,000 in 2025. And we've seen a lot of high net worth families that super fund early, let it grow over time, and potentially even use it for education purposes for next generation cousins, grandchildren. And that's one way that we've seen high net worth families really look into the 529 plan strategy.
And so how do you balance saving in a 529 versus some of your other goals like saving for retirement?
So I'm actually a sandwich generation. So I've got retirement priorities that I'm looking to, got aging parents that I'm concerned about in regard to their care and funding of their care. So it's really about looking at your strategies and prioritizing the most important ones. So education can be paid for many different ways. It can be funded from cash flow that year, school loans, 529 plans. Typically, retirement is going to be funded through Social Security, potentially, and what we've saved. So you want to prioritize retirement first, education savings second, and then really assess what it is in your family and aging parents that you might need to fund later. But it's really about prioritizing and continuing to fund, like I said, early and often.
Jennifer, thanks so much for taking the time here with us today. Appreciate the advice.
Thank you.
A recent study by Allianz found nearly 2 in 3 Americans, or 64%, worry more about running out of money than death. And even with this fear, 62% say that they are not saving as much for retirement as they would like. So we want to help you get retirement ready by talking about how much money you can spend in retirement without running out. One common method is known as the 4% rule. According to Schwab, the 4% rule says that you should add up all of your investments and withdraw 4% of that total during your first year of retirement. In subsequent years, you adjust the dollar amount to withdraw to account for inflation. By following this formula, you should have a very high probability of not outliving your money during a 30-year retirement. But our next guest says that this is not a one-size-fits-all plan. Here with more, we've got Rob Williams, Managing Director of Financial Planning at Schwab Center for Financial Research. Rob, good to have you here. So let's just start with this. Why is 4% a reasonable place to begin?
Well, it's a rule that's been around for almost 30 years now, and it was a great place to start because, as you said, Brad, so many people worry about how much to spend in retirement and need a place to start. But a couple things that we've written about and I think are important. It's a rigid rule, so it assumes that you increase that dollar amount. So say 4% times a million, that's 40,000 each year with inflation for a 30-year retirement, and never make any adjustments. It also assumes that you want a very high probability that your money is not going to run out, which makes sense. But what if you can remain flexible and make some adjustments? And most of all, it's not personalized. It's a fine place to start, but with technology, with modern planning, we can do a lot better if we know a little bit about your situation and you can remain flexible.
So how do you determine your own personalized spending rate?
Well, the first is to determine what your time horizon is, because a 30-year retirement, if you're 65, which is what the 4% rule was designed for initially, 65 to 95, that's a 30-year retirement. But let's say you're in your 70s. Well, perhaps you could spend a little bit more than that. The other is, how much confidence do you want to have that you're not going to run out versus legacy goals, so leaving money behind. And if you want very high confidence, you spend less and potentially invest a little bit more conservatively as well. And the one that I think is most important is, how flexible can you be? Can you divide your expenses into your essential expenses and then some discretionary expenses? And most investors and retirees naturally are going to cut back on some of their discretionary spending, say in a down market. And if you do that, that can really help your savings last. So how flexible can you be? Those are three questions to ask to help you get to a more personalized spending rate.
So once you've asked yourself all these questions, just take us through the math here. Let's assume 30-year time horizon and a conservative allocation here. Then how do you make sure that that plays out correctly and you don't run out of money?
Sure, and this is a simple chart that we've put together, and there's more to it, but in different scenarios. But in this scenario, let's take the conservative example. Conservative at the top means how aggressively you've invested your portfolio. And in this case, based on our research and our numbers, the conservative portfolio is 60 to 70% bonds and the rest in stocks. And the more aggressive portfolios includes more stocks. And what it says is, in this case, you spend 4.1% in the first year of a 30-year retirement. And then based on our current projections of how we think different asset classes, stocks, bonds, et cetera, will perform, 4.1% would be the highest initial spending rate that first year, as you described, Brad, and then you increase it every year with inflation to have a very high, a 90% probability of lasting through retirement. So that's what the table means. It's a fine place to start, but for all the reasons I suggested, you can do much better by personalizing it, by staying flexible and using a modern retirement income plan.
Rob, good to have you here with us. Thanks so much.
Good to be here. Thank you.
Coming up, everyone looking to save up for your first home, college education, or pay off debt, these expert saving strategies can help. That's next on Wealth. According to a recent survey by Allianz Life, 70% of Americans feel financially prepared to reach their goals. But nearly all think that they would be better prepared if they had a financial plan in place. So for some tips on saving for your goals, I want to bring in Jean Chatzky, who is the Her Money Media CEO, as part of our saving series brought to you by Synchrony. Jean, great to see you. How can savers use behavioral finance to help save for those milestone goals?
Hey, Brad. And I love that question, because the problem with saving money is that human beings are just not wired to be good at it. And so we've learned a lot from the field of behavioral finance in terms of tools that we can essentially use to help us get out of our own way. And the biggest by far is automation. If you think about why a 401k plan works, and they do work, it's because it's automatic. The money comes out of your paycheck. You don't see it. You don't touch it. You don't spend it. And the trick is to try to take what we've learned from that 401k and just apply it in other areas of your life. So if you're trying to build an emergency cushion, whenever your paycheck lands, you want to automatically move some money into a savings account. Same with 529 college savings plans. Don't wait to make yourself do this on the regular. Instead, just automatically move the money. And if you don't have a 401k or another work-based plan, this is even more important. Make sure that you are automating contributions into an IRA or a Roth or a SEP or whatever kind of an account you're using to get you there.
How do you know when it's time to modify the percentages that you're automating for your savings as well?
Look, I'd like to see people get to a point where they are saving a solid 15% a year. And that basically counts on the fact that you're going to be doing this for decades. If you're getting a late start, you got to save more in order to have that 30-year retirement that your last guest was talking about. We don't get there by automatically starting to save 15% because it feels like a crash diet. It's just too much. What we do know is that we can nudge our way there by about 2 percentage points at a time every time you get a raise or once a year until you're hitting that goal.
So how can people balance their financial equation here? This is something that we often hear about it. And for some people, it can be quite the chemical equation to try and balance.
Can go kabloom, right? Yeah, no, the problem is that when you are looking to control your money and when you're looking to achieve a certain savings rate, there are two sides to the financial equation. And often we try to nickel and dime our way there by trimming our expenses to the bone and cutting things out. When if we've done enough of that already, what we really have to look at is the money coming in and whether there is a way to improve the income that we're getting from our day job, improve the income that we are getting from some sort of a side gig, look at picking up some extra hours. If it's been a while since you've looked at that side, the left side of the equation, as I like to think about it, maybe it's time to talk to your employer about additional compensation.
And so you also talk about making your goals visible. What do you mean by that?
Yeah, this is another behavioral finance hack. And it's essentially, if you can see it, it's easier to accomplish it. So if you know that you are saving for a home renovation because you want a kitchen that you saw on House or House Beautiful, rip out a picture or print out a picture of that kitchen and put it someplace that you can see it and name that account for that goal, the kitchen renovation fund. You want to continually remind yourself of these things because it makes it easier when you are sitting and shopping on your computer late at night, staring at some jacket or pair of shoes or something that is just calling your name in the moment. If you've got that reference point of the kitchen, it makes it easier to not buy the shoes.
Jane, great to see you. Thanks as always for some of these really key pointers for savers out there.
Nice to see you too.
Health savings accounts could get a big boost under President Trump's tax package. The legislation passed by the House now heads to the Senate for consideration. Here with more, we've got Yahoo Finance senior columnist Carrie Hannon. Carrie, there are a ton of changes to HSAs under this legislation, but let's start with the big one, increased contribution limits. What are we seeing there?
Yeah, Brad, absolutely right. This is one sort of glimmer in this bill that I think is worth noting, is they're talking about doubling the annual contribution that people can make into these health savings accounts. And so it would go to $8,600 for individuals and $17,100 for joint or family plans. This is a huge jump of what people can set aside. Now, again, just as a reminder, these health savings accounts, these HSAs, are for people that have high deductible healthcare plans. So what that means is this year, if you're an individual, your deductible would be $1,650, or if you're a family plan, it would be $3,300. So just understand who we're talking about. Now, quickly, I just want to say why I absolutely love HSAs. And many financial planners say this is a terrific retirement tool for people if they focus on saving in these accounts for the long-term medical costs, for the future instead of using them for the immediate cost, which is what most people do. What these accounts have, Brad, are the triple tax advantage. No other account is like this. You don't pay tax going in with the money. You don't pay tax on how the money grows in these accounts, nor do you pay tax when that money comes out if it's for a qualified medical expense. So this is something that unfortunately, a lot of people don't pay attention or don't understand the investment aspect of these accounts. And also a small percentage of people really are taking advantage of all of this because they're not even putting the full amount they have today because they're concerned about paying, they're saving and paying for many other things in their life. So it's just one thing that I think this is a bright light if people can put more aside in these accounts.
There's also a bit more flexibility for married couples under the bill. What does this entail exactly?
Right, Brad. So there's lots of other little pieces to this. One is that for married couples, right now, if you have a flexible spending account, one spouse says the other one has an HSA, you can't contribute to both. So you have to select one to do. Now this will open this up that you'll be allowed, spouses can do both plans. If one has one has the other. The other thing is it will allow people to can combine them in one health savings account, both spouses, their contributions and their catch-ups. And this gives it a bigger oomph in terms of if you're using it as an investment account. But Brad, there's some other fun things in there as well. Like, for example, you'll be able to use these accounts for many gym memberships, which is something that they consider that now a qualified, or they would consider it a qualified medical expense. Or if you have one of these concierge medical plans where you pay an annual fee, they're going to let some of those be considered qualified costs as well. So, and they've expanded the kinds of plans that can offer health savings accounts. So I think we're seeing some more movement to kind of give some juice to these HSAs, and hopefully it can be helpful for many people saving for retirement and saving for today's medical costs.
Carrie, great breakdown as always. Thanks so much.
Thanks, Brad.
Let's do a final check of the markets here as we're taking a look at the major averages on the day. We've been seeing them higher in the green, coming off of a little bit of a cooler head prevailing for right now in some of the trade front. As we're taking a look at the Dow, the S&P 500, and the NASDAQ, you're seeing gains across the board, led by the tech-heavy NASDAQ on a percentage basis by about 2%. On a point basis, you're seeing the Dow Jones Industrial Average leading by about 600 points right now. 1.4% is what that translates to. S&P 500 up 1.7%. Let's also take a quick look here at shares of Nvidia. They are higher by about 2.8%. The company reports earnings Wednesday after the close. We'll be breaking that down for you, and we have a special coming your way. That's it for Wealth, though. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close. Have a great day.